UBS agrees to buy Credit Suisse for more than $3 billion. The deal is a part of the effort to prevent further erosion of confidence in the banking system. A 167-year run for Credit Suisse has come to an end. This news came following the unfortunate events that unfolded before us, which led to the collapse of multiple banks. Silvergate, Silicon Valley Bank, and Signature Bank were all victims of failure in the month of March. Since the SVB collapse, First Republic Bank has seen depositors fleeing, taking $10 billion a day with them. Banks are dropping like flies, and to prevent further panic, bank runs, and any more collapses, steps are being taken. Before we dive into this one, if you haven't yet watched our latest video, which covered the SVB collapse and what happened that led to its failure, make sure you go watch it so you can fully understand the events that are going on. The video is linked in the description below. Also, make sure you like and subscribe for more, and let's get right into it. This arranged marriage-like deal between UBS and Credit Suisse is an interesting story to follow. UBS was backed into a corner to absorb Credit Suisse. Nonetheless, they are getting the deal of a lifetime. And in addition, they are eliminating their rival. The price that is being paid is $3.2 billion in an all-share deal. Prior to this, UBS had made offers for $1 billion and $2 billion, which were both turned down. But now in this $3.2 billion buyout, UBS will pay 0.76 Swiss francs per Credit Suisse share, which comes around to 82 cents a share. The stock closed at $1.86 a share on Friday, but has since gone down to 88 cents a share at the time of this recording. It is hoped that this deal would allow UBS to enhance its leadership in private wealth management while also expanding its presence in the investment banking and trading. UBS, however, does intend to downsize the Credit Suisse investment banking business, and the chair of UBS said that the combined investment banking business will over time account for no more than 20% of the group's risk-weighted assets. The deal has been welcomed by some market observers as a way to strengthen the Swiss banking sector in a time of uncertainty. Others, however, expressed concern that this could lead to further consolidation in the Swiss banking market and result in less competition. It is yet to be seen whether this deal will be beneficial or not. However, one thing is for sure. It does give a clear message that the Swiss banks are taking action in order to prevent further economic collapse. The Swiss government will be providing UBS with $9 billion to backstop losses UBS may incur by taking over Credit Suisse. Credit Suisse being in trouble is nothing new for them, and their problems started years ago with a chain of market crises, financial losses, and compliance violations. They took a $5 billion loss due to the collapse of their client, Archegos Capital Management, and that ended up amounting to a year's worth of revenue for them. It also didn't help their case that they reported a loss of 7.3 billion Swiss francs for the year of 2022 and a $1.7 billion loss the year before. They were already on thin ice as is. Last year, their deposits fell by 40% and total assets dropped by 30% due to scaling back business. Then the recent events began to unfold following the collapse of Silicon Valley Bank. After that went down, a lot of people became very speculative of the banking industry in general, and sell-offs of bank stocks began, including Credit Suisse's. Things really took a major turn when Saudi National Bank, Credit Suisse's largest stakeholder, said in a Bloomberg TV interview that it wasn't considering adding to its investment due to regulatory rules. Capital requirements limit banks to 10% ownership of other banks. Saudi National Bank had a 9.9% ownership in Credit Suisse and had no interest in increasing it. Or to put it simply, it would not be offering Credit Suisse any more assistance.
Back in October, you and I had a discussion, and I had multiple discussions at the time. And at the time, we articulated very clearly that we would not go beyond 9.9. Even if we desired to, there are too many complications from a regulatory and a compliance point of view globally to do that, so we were not considering that. Yesterday's message was exactly the same.
Some are even pointing the finger at the chairman of the Saudi National Bank as the cause of sending the bank over the edge. Following that, Credit Suisse stock price plummeted 24% last week, and this caused a frenzy among investors. Traders began buying puts on the company, which outnumbered the bullish call options, and it got to the point where the bank faced $10 billion a day in customer withdrawals. They needed a lifeline, and they needed it fast. They got one, a $50 billion one from the Swiss National Bank. This only delayed the inevitable. Credit Suisse needed a rescue. It came down to either letting the bank go bankrupt and fail, or being absorbed. Enter the Union Bank of Switzerland. Allowing Credit Suisse to go under would have drastic effects and cause a global ripple. Priority became to prevent a global financial crisis and the collapse of all banks worldwide. A lot of people got burned from this deal, especially the bondholders. As a result of UBS taking over Credit Suisse, the Swiss regulator FINMA announced that additional Tier 1 bonds worth $17 billion would be eliminated. Let me explain what an AT1 bond actually is, since it stirred up some drama. An AT1 bond, also known as additional Tier 1 bond or contingent convertible, is a type of debt security issued by a bank or financial institution that counts towards its Tier 1 capital. It is considered to be a type of hybrid security because it has features of both debt and equity and is used in Europe and Asia. AT1 bonds have no maturity date, and the issuer has the option to defer interest payments or convert the bond to equity if certain conditions are met. This makes them riskier than traditional bonds, but also potentially more rewarding for investors as they offer higher yields. However, AT1 bonds are also subject to regulatory restrictions and can be written off or converted to equity in the event of the issuer's financial distress. These were created following the 2008 financial crisis to shift risk from us humble taxpayers to the investors. So this way, in a time of financial distress, the banks don't receive a taxpayer bailout, but rather convert the bonds into shares. If that made no sense, think of it like this. An AT1 bond is like a loan that you might give to a friend, but with some special conditions. Imagine that you lend your friend some money so he can buy a bicycle, but instead of setting a specific date for when they need to pay you back, you agree that they can pay you back whenever they're able to. However, if your friend runs into financial trouble, they might not be able to pay you back in cash, so they might offer you some ownership of the bicycle. In this case, things went a little bit differently. Since UBS is buying out Credit Suisse in order to reduce exposure, FINMA has announced that these bonds will be wiped out. Worthless. $0. That means you're not getting your money back or any ownership of the bike that your friend sold. You got scammed. The total amount of bonds being wiped out is $17 billion. That's this much cash turning into a big load of nothing. So now, does that make you feel better about your red portfolio that's 70% in the ground? Of course, this did not go over well with the bondholders, and lawsuits are coming, rightfully so. On the other hand, Credit Suisse's AT1 bonds offered yields a lot higher than assets in comparison, in some cases as high as 10%. And here's the catch, they also contained a clause enabling them to be written down to zero by Swiss authorities should the bank no longer be viable, whether or not stockholders were affected. The shareholders aren't as unlucky as the bondholders because they are set to receive 0.7 Swiss francs per share or 82 cents. This arrangement, however, did not favor the Saudi National Bank. They are being hit with an 80% loss. Remember earlier I mentioned that they own 9.9% of Credit Suisse? They invested 1.4 billion Swiss francs, which is 1.5 billion US dollars, in the bank in November of last year, and their per share price was 3.82 francs per share or $4.14 per share. Again, UBS is paying shareholders 0.76 Swiss francs per share. That's quite a smack in the pockets if you ask me. I mean, the total loss they are taking on is over $1 billion. Despite the loss, SMB says their strategy remains unchanged and that as of December 2022, their investment in Credit Suisse was only 0.5% of SMB's total assets and 1.7% of their investments portfolio. There are ways that this turnout could threaten the $250 billion AT1 bond market. Investors will want a higher premium to hold these bonds going forward after seeing the Swiss regulators wipe out $17 billion worth in one fell swoop. I guess I don't blame the investors who are uncertain and don't want to touch these securities after watching something like this go down. In the midst of all this, the Fed and global central banks are setting up a joint liquidity operation. Liquidity swap lines refer to agreements between central banks to provide each other with access to liquidity in times of stress in financial markets. For example, let's say that the central bank of a country is facing a shortage of US dollars to meet the demand from its domestic banks. If it has a liquidity swap line with the US Federal Reserve, it can borrow dollars from the Fed by exchanging an equivalent amount of its own currency. This can help ease the liquidity pressures in country A's financial system and support the stability of its domestic currency. Liquidity swap lines are typically set up for a fixed amount of time and have predefined conditions such as interest rates and collateral agreements. These agreements can help mitigate liquidity risks in the global financial system and promote financial stability by ensuring that central banks have access to the liquidity they need to support their economies. That's all for this one, guys. If you made it to the end, I want to thank you for watching. If you'd like to hear more from us, don't hesitate to like this video and subscribe for more content. Comment down below your thoughts on this one and hit that notification bell as well. Other than that, stay safe and stay informed.